in my career, during most difficult times in the market, recession times, I know there's a big debate as to whether we're in one or not. And I know there are perhaps political dynamics at work suggesting that no one wants a recession in a midterm election year. But we believe we're in a recession. But if we're right, then the downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported.
ARK Invest CEO and CIO Cathie Wood was one of the first market experts to declare that the United States economy was in a recession. Her team's work on disruptive technologies over benchmarks has made her the focus of the media for the past 2 years, especially after her bets paid off significantly during the pandemic. As a result, she does extensive research on the markets and the economy, which she frequently shares with the public. In a recent broadcast titled Keeping at It, a reference to Federal Reserve Chair Jay Powell's Jackson Hole speech, Wood gives an update on the markets and the economy as a whole. 2 burning economic issues for the United States and the rest of the globe are inflation and recession. Over the past year, most economies have seen an astronomical rise in prices, especially in goods and energy prices. For the most part of 2022, the United States has had a steady 40-year high inflation rate with up to 76% increase in energy prices. But most market experts, including Cathie Wood, believe the figures we are getting are only a fraction of the actual state of the economy. In her broadcast, the University of Southern California alumna maintains that the United States is in a recession, even though policymakers are fighting to keep this from the public because of the midterms. She also talks about supply chain issues and the effects of the monetary and fiscal tightening policies on an economy that is having a severe economic downturn. We will now take you to Cathie Wood's broadcast. Don't forget to smash the like button, subscribe to the channel, and drop your comments and observations in the comments section below. Also, make sure you check out our other videos to stay updated on market trends. Let's dive right in.
It is true. The last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. And we also did not predict, no one did, the Russian invasion of Ukraine, which has sent food and energy prices soaring, which is a really cruel tax on the consumers around the world. So I've also not been in a period where fiscal and monetary policy during a recession have actually tightened up. Typically, fiscal and monetary policy are contracyclical. In other words, when the chips are down, the economy is in recession, usually fiscal stimulus and monetary stimulus follow pretty quickly. And instead, what we're getting now is the opposite: fiscal policy tightening, including the Inflation Reduction Act, and monetary policy tightening, and tightening aggressively. So fiscal policy. We got the Inflation Reduction Act, and as I think many studies have corroborated, the initial University of Pennsylvania analysis was that it would not reduce inflation per se. And yet we probably will see lower inflation. So, I think that the administration will take the credit for that. And frankly, all I care about is that inflation unwinds. But to understand the pro-cyclical nature of this policy, taxes will go up. Now, this is over a 10-year period by $737 billion, and spending will go up by 437 billion, thereby reducing the deficit. Now, if that were correct, and I don't think it will be, these numbers are never really correct, but if that were correct, the deficit would be shrinking. And we do know that federal outlays still are down 15% year over year. So that gets into our GDP accounts, and government accounts for 20% of our GDP. So down 15% in 20% of the economy, that is fiscal drag, and is contributing to the recession we believe we're in. On monetary policy, so Chairman Powell gave his annual presentation at Jackson Hole, or gave the Fed's annual presentation. And we read line by line what he said, and it was very interesting. He invoked the name of Volcker, former Federal Reserve Chairman Volcker, who really combated the inflation of the late 70s and early 80s. He invoked his name twice, but he also hinted by using the phrase keep at it or keeping at it twice. So that was really a reference to the late 70s, early 80s. And I really do believe that the Fed believes that we have a problem that might be that significant. If they didn't believe it, they wouldn't be acting this quickly. And I think they're awfully afraid of ruining their own legacies. They do not want to be known as the Federal Reserve members who presided over another big wave of inflation.
There have been two narratives about Powell's extremely hawkish Jackson Hole speech. Some people, like Real Vision's CEO Raoul Pal, believe the Fed is only trying to lower inflation expectations. They believe Powell was trying to sell a false narrative to the public about the Fed's resolve to go to any length to bring down inflation. But the actual intention behind this speech is to scare the markets and tumble asset prices. Then there are people like Cathie Wood who believe the Federal Reserve is genuinely scared because they are only telling Americans half the real story. Which camp you belong to? Will the Federal Reserve adopt the Paul Volcker-style approach to bring inflation down to the target of 2%, regardless of the damage to the economy? Or are we going to see them reverse their stance as soon as everything begins to fall apart? Let us know what you think in the comments section below while we bring you another important clip from Cathie Wood's broadcast.
As we've been saying for quite some time, we think this inflation is more associated with the shock of COVID and the rebound and all of the distortions that took place because of it. And we're getting more and more evidence about that. Now, one of the things that concerns us is because they are so fearful, the Fed members have taken the Fed funds rate up from 25 basis points, so 0.25%, to 250 basis points, 2.5%, in the span of a half year. That's a tenfold increase. Now, we were in a period, especially after 08-09, where the Fed was, basically laying low and just letting the economy heal. And so we had this extended period of very low interest rates, which started to change in 2017-18. And then they had to rein it back in because at the end of 2018, the economy looked like it was going to fall apart. And then, of course, in 2020, we had COVID. Nonetheless, for most of the last decade, very low interest rates, very little movement in interest rates, and now all of a sudden, a tenfold increase in short-term interest rates. Many people are using the level of interest rates to suggest that this is not really tight monetary policy. It's only 2.5% on the interest rate. But I really believe that change has been a tremendous shock to our system and certainly to housing. We're seeing statistics, and I'll go into them in a moment, all over the place, that housing is in a recession. And I do believe we're seeing evidence that prices are going to follow. So we're concerned that the Fed's overdoing it, and that in invoking Volcker's name twice, outright and then indirectly twice, that Chairman Powell was basically going to say, we're keeping at it, and we almost don't care what happens to the economy. And in the statement, it was very interesting. There was no focus on real economic activity. The only focus was on inflation. So that was a clear message. We don't care. We just want 2% inflation.
Though many market participants believe we are back in a 70s-style economic environment, there are indications that the slowdown has started and the Fed doesn't see it yet. According to Cathie Wood, the U.S. Central Bank relies on lagging indicators such as employment and the Personal Consumption Expenditure Deflator. The Personal Consumption Expenditure Price Index is one measure of inflation in the United States. It includes the broadest set of goods and services and measures inflation based on changes in personal consumption. Despite being a lagging indicator, it peaked in February and has been coming down since then. It is now down to 4.6%, according to data from the Bureau of Economic Analysis. Long-term bond yields, commodities prices, and the M2 money supply, which has stayed flat since March, are all showing signs of economic decline, not growth. If the Federal Reserve continues to jack up the interest rates because of its lagging indicators, then investors and consumers could be in a whole world of hurt. What do you think about Cathie Wood's market update? Please drop your comments and observations below and subscribe to the channel. Also, ensure you hit the like button and turn on post notifications for more videos like this. Thanks for watching.